let's now take a look at how the federal government regulates non-profits or not-for-profits. And let's also make sure that you guys can discriminate between what is a public charity and what is a private foundation, because they are different in a couple of ways. We also need to understand what UBIT is, or unrelated business income tax, that can be applied towards not-for-profit activities and incomes. We need to discuss restrictions on political activity of not-for-profits, and then excessive benefits received by officers, and then what to do if we need to reorganize or dissolve a not-for-profit entity. So in regards to charities, the federal government has actually been encouraging the not-for-profits being instituted since as early as 1894. And the public expects that these tax-exempt privileges that have been granted since 1894 are not to be abused. In other words, organizations should not be using them to perpetrate some other type of activity or service that is not really fulfilling the intended goals or objectives of the not-for-profit and getting away with not paying taxes. So due to that, we definitely need to have monitoring, not only by state and local level jurisdictions, but also by the federal government. So we have got to involve the Internal Revenue Service. So IRS requires registration of all not-for-profits, and therefore our not-for-profits have to comply with meeting the expectations and the criteria of being exempt from income taxes at the federal level. But they also have to comply with general laws that regular businesses have to comply with. All right, so we are in essence kind of running an organization, and there are certain laws in our country that all institutions, no matter their taxability or non-taxability, have to comply with. For example, the FLSA, the Fair Labor Standards Act, EEOC, the Equal Employment Opportunity Commission, the U.S. Disabilities Act, Civil Rights Acts, etc., etc. They still have to comply with that stuff. We're just only talking about the fact that they may be able to qualify to be a non-tax-paying entity. With the IRS registration, they have to file Form 1023, and again, I've mentioned to you guys at least once or twice now that it has to be done in a timely manner. Off the top of my head, I don't know the exact number of days, but there are certain documents that have to be filed with the IRS by different types of entities requesting certain treatment by the IRS, and if they are not done within a specific time frame, then many times you can kiss the opportunity goodbye. So make sure that if you're working in an area that does the filings for clients, that you know what these deadline dates are and share that information with the clients, and make sure that you work with them to hit those dates. That Form 1023 is filed when we're asking for tax-exempt status under the 501c3 of the Internal Revenue Code. We would file that in addition to anything that we've already lightly went over in regards to state or local. All right, so we may have multiple filings in order to get all of the tax exemptions that we want. When the IRS reviews these in order to grant said tax exemption status, the IRS is going to apply a test, and they're going to take a lot of different things into consideration, including what's the stated purpose and what are the service objectives of the organization. Now, We will have to supply them with data in regards to some of this, what exactly we are shooting for, and we have to make sure that a substantial part of the entity activities cannot benefit private interest and may also not attempt to influence legislation. All right, because if it's got any of that involved in it, it will not be granted 501c3. In regards to contributions, we have to track those contributions, both the contributions in dollars and contributions by other forms, such as some type of asset transfer. Maybe someone's got some investment holdings or some type of asset of value. So we have to track all of that. And with these contributions, many of them are tax deductible for the contributors, but then again, some of them are not, or maybe are not completely. So there are some tax class type things that go hand in hand with what we're looking at our level of class. So you could hang on to this textbook and then hang on to your tax book that has the nonprofits covered in it if this is an area that you end up working in later. In relation to these contributions, again, regarding our record keeping and bookkeeping, not only do we have to track it for our records, but we also would have to supply documentation back to the contributors for their tax record keeping and reporting. All right, so certain dollar amount things come into play, certain types of contributions come into play, and disclosures and acknowledgement have to be supplied to those contributors in writing, also stating it's 501c3, but in regards to the amount appropriately deemed needs to be specific on the documentation. Also, in regards to our nonprofits, when we have the filings with the IRS, we're either going to be asking to be reviewed or basically told that we comply with being called and classified as a public charity, or we would just be set up as a private foundation. So per IRS publication 557, every 501c3 qualifying organization, in other words, they've met the qualifications for exempt status. Now what we need to do is classify them, because based on the classification, you have certain things that apply that are either more strenuous in nature or less strenuous in nature. So if we apply and we qualify as a 501c3, then we would be classified as a private foundation automatically unless it meets 509A. And you have to request to be classified as a public charity, and you've got to meet the criteria, and you've got to meet it for sure within 5 years and provide data in the 6th year proving that you did, because the public charities are receiving preferential treatment as opposed to the private foundations. So what are the differences? All right, so the public charities, for the most part, are publicly supported. The contributions are coming in from the public at large, therefore it's publicly funded, publicly operated, and therefore needs to, in a way, be publicly monitored, which gets covered a little bit more at the end of the chapter, because there's a lot of different ways we can review the information about a nonprofit. Not only can we see many of their filings with the IRS, but also some of their data and stats that are tracked by different organizations, because we're wanting accountability for these tax-exempt organizations and the contributions that they're receiving from others. Public charities versus private foundations. Now, private foundations, there are limitations regarding the activities, regarding amounts, contributions, how they're used, etc. With a private foundation, we're typically talking about a small number of individuals or maybe family members, possibly even a corporation that are setting these items up and contributing money to be used for a certain way. Typically exist in order to make grants on to public charities. Now, if we had some time, I would pull up a couple of web pages. We are lucky enough here in Chattanooga to have some old money, if you will, that has left behind some foundations that the city of Chattanooga and the citizens do derive a lot of great benefits from these foundations giving grants to public charities. And maybe I'll load you guys some webpage links for some interesting reading. But these public foundations can be used to benefit great things. With the private foundations, they have to annually file a 990 PF. So 990 is the form number for our tax-exempt organizations, but the PF designation is saying it's a specific 990 for private foundations only. And with these private foundations, they can have taxes imposed upon them when they don't really hold the line. If they fail to take specific actions, for example, they don't distribute a particular minimum amount to public charities, then there could be basically a sanction imposed upon them for failing to do that. Also, if they happen to have prohibited behavior that they take in, for example, excess business holdings or some type of self-dealing transactions with disqualified persons. Like I mentioned, we're talking about many times a small circle of people who have set this foundation up. And if they are using it inappropriately, then that's when we have a problem with it from a general public protection standpoint. At one point in time, I had a political science professor who talked about how massive the Internal Revenue Service, how long and how many pages the tax code is. It'd be interesting to see just what all the rules and regulations are in regards to the private foundations, but it's definitely beyond the scope of this discussion. Back in regards to the public charities, let's talk about them for a few more minutes. Again, they're publicly supported, so at large, we've got a massive amount of money coming in for the public, or at least that's what we are hoping for, because the IRS is going to apply a test to the amounts coming in. And basically what they are looking for, and this is that test that needs to get applied, especially for that 6th-year proof, that when we have the public's share of the support, that the public's share has to be 33% or greater. And when this formula is calculated, any one individual's amount is limited to 2% of the total. So we would take the total, we would multiply it times 2%, and that's the most that could be added in for the public support number, the numerator at the top, for that one person. And if it meets the 1/3 or greater test, then it is publicly supported and therefore a public charity and does not have some of these additional impositions that a private foundation would be subject to. In regards to the public charities, now they kind of have different forms that could be filed based upon, for example, their gross receipts and their total assets. If we're talking about a small public charity. If their gross receipts are 50 grand or less, then they would do the 990N, which is a postcard based, and it's actually probably $49,999.99 or less. And then we have the 990EZ that could be filed by those with gross receipts 50 to 200,000, with total assets less than 500 grand. And then everybody else that's a public charity would be filling out the 990, which is currently sitting at around 12 pages, but it does get edited based on what Congress passes and implies and makes the IRS change on the form. There are a multitude of additional schedules that could be required to be filed based on what is applicable for the public charity. Within your textbook, there's an example or an illustration showing you the format of the basic 990 form, and then it gives you a list of some of the other schedules that may have to be amendments or attachments to the 990. Now, something to keep in mind, you guys, when you go to sit for that CPA exam and you are working on the reg portion of the exam, not necessarily the FAR. The reg is more in regards to filing tax returns and things like that. You could possibly get yourself a 990 for one of your simulations that you may have to fill it out. All right, so having had this class coupled with your tax class, hopefully you could take the data that they give you and fill it in. Again, the chapter after this one, we could be covering it in this class with a substantial amount of homework, but we're not going to, but hang on to it. So taking a look at some of those other items, some of the information that is required could be schedules of contributors, political campaign and lobby activities, which we're going to talk about here in just a second. Because with our 501c3 organizations, no not-for-profit may be participating in any political campaigns on behalf of or in opposition to any candidate for public office. 501c3s may have their tax-exempt status revoked. Now, some charitable entities could file a 5768 and take a 501h election, allowing some direct lobbying to the legislature. Your textbook highlights, for example, lobbying, but also grassroots lobbying. So there's a limit as to what nonprofits can do. And again, as accountants, when you are helping to fill these things out, whether you're working at the firm or working for the organization or maybe even sitting on the board, you may need to dig a little further in regards to the activities of your organization and making sure that you are within compliance. Section 527 is in regards to political organizations such as PACs. You hear the phrase PAC sometimes. That's political action committees. Section 527 also applies to political parties, even campaign committees for government office candidates. Now, in regards to these, they've got to meet the organizational test, again, defining the purpose and the intent like the public and the private charities have to do. But these 527s are subject to special reporting requirements as well as special disclosure requirements. Again, it's all about compliance. If you happen to be involved with one of these kinds of organizations, you need to make sure that there's a separate bank account and that everyone is following the line when it comes to Federal Election Commission rules and the campaign finance reform laws and any applicable filings and documentation retention that may be required based on the jurisdiction you're in, but also at the federal level. So federal level may have requirements, state may have requirements, and even the local may have requirements. You've got to make sure you comply with everybody. With the 527s, they've got something kind of like the 990, where the 990 had the schedule of contributors, where we've got the amounts and the names of the individuals who contributed money to those nonprofits. With these 527s, they've got Form 8872, and it is to disclose the names and addresses of individuals or others who have contributed $200 or more annually, and also disclose $500 or more in expenditures to particular individuals. Now, this Form 8872 comes up occasionally within the news if you wanted to look into that a little bit. Of late, you could look up Dinesh D'Souza and Rosie O'Donnell, both of which who have been in the news, one of which has been to jail over contribution issues. There are federal and state rules regarding the amount of activities that these organizations can be involved in regards to propaganda, and also the amount of activities they can be involved in as it relates to attempts of influencing legislators. So things to be concerned with. Again, I would always be doing my research if I was the one having to make sure compliance was in check. A couple of last things to mention here in this particular video segment is related to that unrelated business income tax, the UBIT or UBIT. In 1950, Congress passed the first UBIT, and basically what it is on Form 990T, which also has to be made publicly available. All these 990s and their corresponding information, the majority of it is publicly available. We may be able to access an IRS website to get to it, but also these nonprofits should be providing it, whether it's found literally on their website or you contact them and ask for a copy of it. For like 3 years, they've got to make sure that you can see it. But the UBIT is basically a tax being imposed by the federal government at corporate rates on income earned from activities of not-for-profits that are activities that are not substantially related to their charitable activities. There's a calculation that gets done, and there's some exclusions that apply. Again, your textbook goes into quite a bit more detail, a scope issue, if you will, but it applies to almost all not-for-profits, as well as some public colleges and universities. So we could even talk about what goes on at the bookstore over at the UC at UTC. Some of the items that are definitely going to have the UBIT applied to them: rents from debt financing properties, rents based on a percentage of net income rather than gross income, and rents on personal property. Also, corporate sponsorships that appear in regularly published periodicals could also be applied the UBIT against it. In regards to feeder organizations, and these are organizations that may be controlled by a nonprofit, and the feeder organization carries on some type of a trade or business that basically the profits from it are sent back to the nonprofit for their use. The income passed from the feeder to the not-for-profit organization in the form of interest, rents, royalties, and annuities is subject to unrelated business income tax, but some activities that are not going to be subject are things like generate rental income that would be excluded from rent. So anything that would be excluded. And I'm sure the tax code's got a detailed list for us if we had to go research it. If the activity at the feeder organization uses volunteers for substantially all the work, and if they sell merchandise that was substantially all contributed. And I know we can think of a couple of organizations that fit that bill that have stores where people donate things and the workers are volunteers or possibly even employees of the organization, and the profits from those sales or that activity, the UBIT may not be applied to that. In relation to unrelated debt finance income, if a not-for-profit has income from an asset that is mortgaged or debt financed income, in other words, they have some type of rental income coming from an asset that has a mortgage on it, in other words, a notes payable with principal and interest required, that income is UBI. So it is unrelated business income. However, there are some exceptions to this. So depending on the organization you may be dealing with, you may really need to research to make sure that you are applying the tax via that 990T correctly, or maybe the tax doesn't actually apply. Please do not be a same as last year accountant. I preach about same as last year accountants in my forensic accounting class for sure, because I don't want them to be same as last year auditors. Do not always assume that the person who did something prior to you did it correctly. Use your brain, do some research. When you're questioning something, look into it. Brings me next to excessive benefits received by officers. Again, you don't want to have any type of sanctions imposed on the organization by an IRS because that's going to be costly in a multitude of ways. It could be costly in regards to basically what results as fees or fines, if you will, penalties, maybe even interest. But also if it somehow has to be disclosed to the public, then how do you think your contributors are going to feel? So if, for example, there's some type of excessive economic benefit received by an officer of the not-for-profit, then you're going to have an issue. There could be penalties, and we're talking about things such as unreasonable compensation, which means when you're going about setting up the pay scale or pay structure of how management and officers are going to be compensated, then you need to have somebody do a compensation study, and you need to be using comparable salary information for the type of position that the person is filling. You also need to be concerned if the not-for-profit is selling off some type of assets, and you may have a party that is considered a disqualified person. A disqualified person is anyone who has substantial influence over the organization's affairs. And so if one of these disqualified people who has substantial influence is the recipient in a transaction for a sale of assets, and they did not have to pay a market price, if you will. In other words, they bought it for a super duper deluxe good buddy discount bargain price, then you may have an issue. And the taxes can be extreme, not only to the disqualified person, but also to the not-for-profit. Last thing to discuss in this particular segment is the reorganization if necessary, or dissolution if necessary. So if a not-for-profit finds itself in a situation where they are no longer doing the types of things that they intended to, that they filed in their initial filings with the Internal Revenue Service in order to receive their tax exemption status, then they may need to redefine their mission or find another organization to merge with, or even dissolve the organization. All right, so if that's the case, if we are going to be dissolving it, all of the creditors need to be paid off. Okay, it's kind of like filing bankruptcy, but you're not filing bankruptcy. Everybody needs to be paid off. And then all the federal, state, and local taxes, if there are any, also need to be paid off. And then any assets that happen to remain need to be transferred to another tax-exempt organization. In other words, they are not to be disseminated amongst the directors, the board, and the employees of the nonprofit. That is not acceptable. In regards to involuntary dissolution, which could actually occur, typically that is when the nonprofit fails to file an annual report, or as a result of a state attorney general's determination of some type of fraud or unlawful conduct. So basically they can be imposed with having to dissolve even though they did not want to. Kind of like the involuntary bankruptcy that can also occur to for-profit organizations.